The math is breaking, and they're still telling you it's a transitory adjustment. The mainstream narrative is a ghost story at this point, a fairy tale designed to keep you strapped to a sinking ship, while the people in the lifeboats are busy loading up on physical bars and defense contracts. We're not looking at a market correction. We're looking at the total systematic evaporation of the safe haven as we've known it for 40 years. The 60/40 portfolio is dead, not just wounded, it's buried. The official statements from the Fed and the Treasury are talking about controlled easing and soft landings, but the raw numbers scream a different reality. Gold is screaming it. When you have an asset hitting $4,500 an ounce in late December, that isn't speculation. That is a flight from a burning building. Gold has outperformed almost every single paper asset on the planet this year. And it's not because people suddenly found a new love for jewelry. It's because the counterparty risk of holding government debt has finally crossed the threshold from theoretical to inevitable. Think about the disconnect here. The Fed is actually cutting rates, or trying to, and bond yields are rising. Do you understand how broken that is? Usually, when the central bank pivots to cuts, bonds rally, prices go up. But in 2025, the opposite. Bond prices are cratering because the safe side of the ledger has become the most dangerous place to be. We're in a policy paradox where the traditional inverse relationship is just gone. It's a sovereign debt trap.
While the suits on the news are debating whether inflation is sticky at 2.7% or 3%, the market is pricing in something much darker. It's pricing in fiscal dominance. It's the realization that the government has to print to pay the interest on the debt they printed to pay for the last crisis. It's a loop. And while your defensive bond funds are bleeding out, the real defensive sector has shifted to literal defense. We're talking about an age of rearmament where NATO is looking at 5% of GDP spending targets. Lockheed Martin, BAE, Rheinmetall, these aren't just stocks anymore, they're the new utilities. Your safety is being swallowed by the very institutions that promised to protect it. You were told bonds were the anchor, but the anchor is made of lead, and the ship is already underwater. There's a hidden mechanism beneath this shift, a de-dollarization 2.0 that the central banks are playing while they tell you to keep buying treasuries. They're selling what they want you to buy so they can buy what you don't own yet. And if you don't see the pattern of who's actually moving the money, you're the one providing the liquidity for their exit. The real question isn't why gold is at a record high. The real question is why anyone is still holding the paper that's trying to replace it. And I'm about to show you exactly how this trap was set.
To understand why the floor is falling out from under the global economy right now, you have to stop looking at the 24-hour news cycle and start processing the long-term math of the safe haven lie. The mainstream narrative wants you to believe this bond crash is a fluke, a temporary reaction to geopolitical jitters. It's not. To understand this crash, you have to process what happened back in the mid-2010s and through the 2020 pandemic. We spent a decade treating debt like it was free, and now the bill isn't just due, the collectors are burning the house down to get it. For years, the standard argument was always, the U.S. can't default because we print the currency. It's the ultimate straw man. They use it to shut down any conversation about fiscal responsibility. They say, don't worry about the deficit, look at the low interest rates. But they ignored the fundamental law of physics and finance. You cannot print your way out of a supply chain-driven inflationary spiral. When you flood the world with paper while the world is simultaneously deglobalizing and rearming, that paper becomes a liability. The villain here isn't one person or one party. It's the collective delusion of the central banking system that thought they could manage the term premium forever. Look at the policy paradox we're living through. The standard playbook says that if the Fed cuts rates, your bonds should go up in value. That's Finance 101. But in 2025, that logic has been inverted. The Fed is desperately trying to ease the pressure, but the market is looking at the sheer volume of debt being dumped into the system to fund infrastructure and defense and saying, no thanks. When the government floods the market with new debt to pay for old debt, they have to offer higher and higher yields just to find a buyer. That's why your safe bond portfolio is hemorrhaging value even as rates supposedly drop.
When that bond index drops, it doesn't just mean a red line on a digital chart for some billionaire. It means your grocery bill stays high because the currency is being devalued to keep the debt engine running. It means your pension fund, which is likely stuffed with 10-year and 30-year Treasuries, is losing its purchasing power in real time. This is the inflation monster swallowing the very assets that were supposed to protect you from it. And here's the most cynical part, the easy fix they keep promising. They tell you that once the tariffs settle or the conflicts in the Middle East and Ukraine stabilize, everything will return to the old 60-40 normalcy. That is a lie. There is no normal to go back to because the BRICS Plus nations have already seen the blueprint. They've watched the West weaponize the dollar system, and they've spent 2025 aggressively selling U.S. Treasuries to buy physical gold. This de-dollarization 2.0 is a structural shift, not a temporary protest. They are exiting the paper game because they know the paper is backed by nothing but a promise that the printer won't jam. The villain is the fiscal dominance that forces the hand of every central bank on Earth. They are trapped. If they raise rates to fight inflation, they bankrupt the government. If they lower rates to save the government, inflation eats the population alive. They've chosen the latter. They are letting the bond market die so the state can survive. It's a calculated sacrifice, and your retirement fund is the offering on the altar.
The real-world translation of this is brutal. While gold hits record highs over $4,500, the cost of living isn't just rising, it's accelerating. We're seeing a death of the bond rally because nobody wants to hold a 10-year IOU from a government that is spending 5% of its GDP on missiles while its interest payments exceed its defense budget. It's a math problem that has no soft solution. The easy fix of more printing only fuels the fire, making gold and literal defense stocks the only logical lifeboats left in a sea of devalued paper. The easy fix isn't coming because the machine itself is fundamentally broken. To grasp why your safe bonds are being incinerated while gold is touching the stratosphere, you have to understand the mechanism of the rigged casino. Imagine you're sitting at a high-stakes poker table. For decades, the House, the central banks, and the government has been the dealer. They've always had a safety rule. If you lose too much, you can trade your chips for a bond token. These tokens were guaranteed to hold their value, and the House promised they'd always be worth more than a regular chip because the House was the most powerful entity in the world. Investors flocked to these tokens. They were the anchor of every portfolio. But here's the twist. In 2025, the House has started printing so many regular chips to pay for its own mounting debts and its massive new rearmament orders that the floor is literally covered in them. To keep the casino from closing, the House is now forcing more and more bond tokens into the market just to pay the interest on the previous bond tokens.
Suddenly, the players realize something terrifying. The bond tokens aren't a store of value anymore. They're just more paper from a house that's drowning in its own debt. This is the supply glut. When the house tries to lower the interest on those tokens to make them easier to pay back, the players at the table don't celebrate. They panic. They see that the house is trying to inflate its way out of the hole. So they start dumping the tokens at any price, pushing the yield, the cost for the house to borrow, straight through the roof. This is the fiscal dominance trap. In a normal world, the Federal Reserve is the boss of the economy. In a fiscally dominant world, our world as of December 25, 2025, the Treasury's debt is the boss of the Fed. The Fed wants to cut rates to save the economy, but every time they whisper about a cut, the bond market sells off because it knows the printer is about to go into overdrive to fund the deficit. The medicine has become the poison. You see it in the math. We're looking at a $2 trillion annual deficit in the U.S. alone, while interest payments on the national debt have officially eclipsed the defense budget. And speaking of defense, that's the other gear in the machine. We're in what the analysts are calling the age of rearmament. When NATO pushes for 5% GDP spending, they aren't paying for it with tax revenue, they're paying for it by issuing more debt. It's a toxic relationship between the state and the market. The state needs the market to buy its debt, but the market needs the state to stop printing money. Neither can give each other what they want.
I know, it sounds impossible. We've been told for 40 years that the full faith and credit of the sovereign was the ultimate shield, but patterns don't care about your feelings. The pattern we're seeing right now is a domino effect that is already mid-topple. Domino A, the government runs sticky inflation due to tariffs and massive infrastructure spending. Domino B, this devalues the currency, making long-term fixed income assets, bonds, a guaranteed losing bet. Domino C, institutional investors and foreign central banks, the smart money, start front-running the collapse. They dump the bonds, domino D, and rotate into hard assets that the government can't print. That's why gold is at $4,500. It's not a bubble, it's a liquidation of trust. The decision makers in DC, London, and Tokyo, they aren't evil in the cartoon sense. They're trapped by their own math. If they stop the printing, the banking system collapses because it's built on a cheap debt foundation. If they keep the printing going, the currency collapses. They have chosen to sacrifice the currency to save the system. They are trying to engineer a controlled demolition of your purchasing power to keep the government solvent. When you see headlines about sticky inflation or yield curve control, what they're actually saying is, we are going to let the inflation monster eat your savings so we can keep the lights on at the Pentagon. The analogy of the casino isn't just a metaphor, it's the mechanical reality. The house is broke, the players are leaving, and the only thing that still has value is the gold bar sitting in the vault that the dealer can't touch. The sequence is inevitable. Once the safe haven of bonds is exposed as a liability, the rush into gold and defense stocks isn't just a trend, it's a stampede.
Drop the optimism. If you're waiting for a return to the normalcy of 2019, you're not just dreaming, you're a target. The next 6 to 12 months aren't about a recovery, they're about the total institutionalization of the chaos we saw in 2025. The data doesn't lie. We're entering a phase of permanent fiscal dominance. That isn't a buzzword, it's a death sentence for passive investing. By mid-2026, the 60-40 portfolio will be seen as a historical relic, a quaint memory of a time when the government wasn't competing with its own citizens for capital. The ugly truth is that the sovereign debt crisis is no longer looming, it's here. Every time the Treasury auctions off another trillion in debt to fund this global rearmament and strategic reshoring, they are effectively sucking the oxygen out of the room for everything else. You're going to see gold targets moving from $4,500 to $5,000 and beyond, not because gold is getting more valuable, but because the paper you're measuring it in is melting. The mainstream narrative will try to spin this as growth, but look at the cost of living, look at the sticky inflation that refuses to dip below 3% despite the Fed's desperate shuffling. They are intentionally letting the inflation monster stay in the room because the alternative, a true debt liquidation, would end the system entirely. In the next year, you're going to see a vision of a splintered world. The global order isn't just fragmenting, it's hardening into competing blocks. This isn't just about trade wars, it's about the literal survival of sovereign entities. We're looking at a society where security is the only growth industry. Defense stocks won't just be a good play, they will be the only sector with guaranteed state-backed revenue streams that are inflation indexed. If you aren't exposed to the age of rearmament, you're essentially shorting the only thing the governments are actually willing to pay for.
But it's more than just stocks and metal. We're moving toward a world of self-reliance. The era of global efficiency is over. It's being replaced by global resilience. This means higher prices, lower variety, and a desperate race for commodities. You want to know what the next 12 months look like? Imagine every country on Earth trying to buy the same limited supply of copper, lithium, and energy at the same time, all while their currencies are losing value. That's not a recipe for a soft landing. That's a recipe for a structural shift in how we value everything. Now, let's talk life advice, heart to heart, because the math is heavy. Stop looking at the screen for validation. The patterns are undeniable, but the truth you're looking for won't be televised. You need to focus on mental fortitude. The volatility we're seeing right now is designed to shake you out of your positions. They want you to sell your hard assets and jump back into the safe paper trap every time there's a temporary dip. Don't fall for the fake-outs. Trust the patterns, not the promises. Focus on your immediate community. When the institutional trust evaporates, and it is evaporating, the only thing that has value is your ability to produce, to protect, and to connect with people who are seeing the same reality you are. Wealth in 2026 isn't just about the number in your brokerage account. It's about your proximity to real assets and real networks. The action plan is simple, but it's not easy. Ditch the safe anchor. Recognize that long-term government bonds are no longer a hedge, they are a liability. Embrace the hard pivot. Gold, silver, and strategic commodities are the only way to maintain purchasing power when the inflation monster is being used as a policy tool. Invest in sovereignty. Whether that's energy independence, physical gold, or local community ties, the goal is to reduce your counterparty risk to zero.
The system is trying to save itself at your expense. They've already made their choice. They're sacrificing the currency to keep the debt machine running. You can either stay on the altar or you can move. The mainstream will call this pessimism. I call it arithmetic. We're moving into a cycle where the math finally beats the magic. The next few months will be a test of who was paying attention and who was just following the script. Don't be the liquidity for someone else's exit. Trust the patterns, not the promises. I'll see you in the comments.